just to kind of jump into some key takeaways that I'd like you guys to walk away with today. First is that the tax code it's always changing. This particular situation, tax reform, and I always kind of do quote unquote reform because reform is kind of a relative term. Not everyone was made better by this. So it's really relative to your situation. But the tax code is always changing. This bill was 700 pages long, more than 43 provisions that impact individuals and small business. So this was significant. And any of the narratives that are out there about this being the biggest set of changes over the last 30 years, I would align with that narrative. So it's substantial, but in general, on any given year, there are hundreds of tax provisions that are changing. And that's because not everything in the tax code is permanent. So there are provisions that are expiring, sunsetting, whatever terminology you want to use. And so it's always this evolving thing. And so you have, to sort of pay the least amount of tax, you need to be aligning your circumstances with the code. But what we're seeing in the models that we've been running with sort of the changes that happened is that with the right planning and right strategy, there's about on average, 7.5 percentage point decrease in the amount of tax that people are saying. So to put that in context, for every 100,000 in income, and these are averages, we're seeing about 7,500 less in tax. So if you had, so you can sort of scale that out and think about how much additional cash flow that could be if you're at 400,000. 7,500 times 4, that's 30 grand, that's a lot of money. So with the right planning, there's significant savings that are out there. So let's kind of get into some things here. Real quick, my bio, I'm a CPA. Founded Nth Degree about 8 years ago with the idea of just doing things a little bit differently and leading with planning and strategy before jumping into tax prep. I've been named a top 40, under 40 accountant 3 times. And the last thing is something that only accountants tend to find cool or interesting, which is I started my career at the boards that create accounting standards. So I helped write an accounting standard, which, like I said, accountants think that's cool. Normal people think that's pretty boring, but put it in there nonetheless. So let's talk about what I like to call the CPA Job Protection Act, but it's more specifically known as the Tax Cuts and Jobs Act of 2017. Also referred to as tax reform. And again, I put this in quotes because reform by definition means to have made something better. That's really, again, a relative position depending on your circumstances and how you sort of optimize things. It was passed on December 22nd, 2017. So unfortunately, Congress doesn't usually give us a lot of time before the year is up to pass these things. But for the most part, for small to medium-sized companies, there weren't really any provisions that would impact you for 2017 purposes. There are a few things that came into play, but for most small businesses, individuals, everything really is going to impact your 2018 tax return. So even though it came at the end of the year, it's really for 2018 forward. And it amends the tax code. And as I mentioned, there are more than 40 key changes that relate to individuals and small business. The Congressional Budget Office reports that pass-through entities, so partnerships, S-corps, sole proprietorships, over the next 10 years will receive about $1 trillion in benefits. That's $1,125 billion over the next 10 years. So it's pretty significant. And corporations would receive about $320 billion. Now the thing to know is that the C corporation rules are permanent. So they're not set to expire or sunset. The pass-through rules, the S-corp partnership, sole proprietorship stuff, that starts to go away and they actually turn into tax increases after 2027. So for the next 9-10 years, you really need to make the most of this, assuming that there isn't some sort of congressional intervention where they change the code again. So just more of an FYI on kind of this isn't a permanent landscape. And an example of the tax code is always changing, and you always need to be thinking about how do you make the most of your circumstance relative to the current code. So first off, this pass-through income deduction, and again, this is if you're an S-corp, partnership, or sole proprietorship. Good news, you get to exclude 20% of your profits from tax. Bad news is that if you're a service provider, there are some additional restrictions. Okay, so as a starting point, say you have 100,000 in profits, you get to exclude 20% of that 100,000, so you're actually just paying tax on 80,000. That's sort of the starting point. But there are limits that apply, and those limits initially kick in if your total taxable income is 315,000. So there's a starting point of if you're above 315,000, you may have some limits. Okay. The next piece then is, are you a service provider or are you not a service provider? Who thinks that the definition of service provider is very clear in the tax code? It's not. They've specifically named certain professionals that are deemed service providers. So apparently, Congress has an issue with CPAs. We're called out. Like, come on, we got to enforce this, and we get limited on this deduction. That doesn't seem fair to me. But we're specifically called out as service providers, attorneys, medical professionals, and there are a few others that are specifically named as service providers. And then it's somewhat left open-ended as to what it means from there. So a lot of folks are thinking about ways that they can position themselves as not a service provider. Because I'll tell you what, if you aren't a service provider and you make more than $315,000, your 20% deduction is limited if 20% of your profits is greater than 50% of the W-2 wages of the business, or 25% of the wages plus 2.5% of unadjusted basis. Pretty clear to everyone? Like I said, this is the CPA Job Protection Act because everyone's like, what is that? Are those even real? Are those English words that you just said? So 50% of wages, that's a relatively easy one. Take the total wages of the company, multiply that by 50%. That's the maximum amount of income that you can exclude. For most businesses, 50% of wages is going to be more than 20% of profits. So if you're not a service provider, you're probably not going to get nailed by that. But there are certain companies, say, you could imagine maybe a large real estate holding company that doesn't have a lot of employees or wages, but they have a lot of assets. And maybe those assets have been depreciated significantly. And so unadjusted essentially means what did you buy the real estate for? So for scenarios, if you're a real estate holder and you don't have a lot of wages, you might have a lot of assets that you've purchased, buildings, and so that exclusion may still apply to you because you get to take 2.5% of what you paid for those properties. So there's a lot of speculation, and I won't politicize this too much on why this favorable real estate provision was added, but it is very favorable if you have significant holdings in that regard. So and it's either one, so 50, whatever's greater, 50% or 25. If you are a service provider, then the scenario, well, let me kind of walk you through the way that works. So say that you're a business with 500,000 in revenues, 200,000 in expenses, so your profit's 300. You're under that 315,000 threshold. You don't have to worry about any of the exclusions. You don't care. You get to exclude 20%. That 20% is $60,000. Under the new tax code, you'd be in the 24% bracket. You're going to save $14,000 bucks. You didn't do anything different from the previous year to this year. You just saved 14 grand from this exclusion. Now, say that you are a service provider and you made 565,000 in revenues, 200,000 in expenses, so your profit's 365. So you are above the 315,000 threshold. Well, once you get to 415,000 in profits, you don't get any of the deduction at all. So basically that 20% phases out as you get up to 415,000. So if you're at 365, that's at the midpoint between 315 and 415. So your 20% exclusion is going to be reduced by 50%. So instead of getting the $60,000 exclusion that I showed you previously, you still get an exclusion. So you're still better off than you were previously, but you're only excluding $36,500. at a 24% tax rate, now your savings goes down to $8,800. There's a fair amount of math you've got to do to calculate this exclusion, right? So what are the takeaways from this? One is, if you are a service provider, end of year planning is becoming much more significant about how are you managing profits to stay below the 315 threshold. So you may be prepaying expenses at the end of the year to try to get below that threshold, because it becomes this multiplier of having additional income that now you're paying tax on, and you're losing out on the exclusion on top of that. Additionally, you just don't want to be a service provider in terms of this, right? Because chances are 50% of wages for your company is going to be more than 20%. And so how do we make sure that you're not a service provider? And like I said, in some instances, you can't get around it because you're specifically called out. But if you aren't called out, then you have somewhat of a decision point about how comfortable am I with gray and how aggressive do I want to be with my tax approach. So this is where there's a lot of kind of one-on-one planning opportunities to make sure that you're not structuring yourself in a way that you're clearly meeting this service provider rule. Couple other things just for consideration that weren't necessarily a part of this, but just are opportunities that we're seeing out there. One is the Masters rule. Who likes golf or familiar with the Masters? Other people call it the Augusta rule. So the Masters, it's in Augusta, Georgia, relatively small town, not a lot of lodging and such. And then you've got thousands of people who are coming in for this tournament. So what happens is people are renting out their homes and for 4 days, 5 days. Well, this specific exclusion says that as long as you rent out your home over the course of the year for less than 15 days, you don't have to pay tax on any of that income. So for people in Augusta, they might be renting their house for $10,000 a day. That's completely free of income tax. So one strategy that we are trying to roll out this year that I think aligns with this Masters rule is maybe you host an event at your house for clients, and so the business is renting your house for some amount, $1,000, $5,000. That's an expense for the business, income to you, except it's not taxable income because you just did it for 1 day. You didn't do it for 15 days. So maybe the company rents a office in your house for 14 days out of the year for $1,000 a day, $14,000. That's a business expense. It's not taxable to you. If you're in a 25% tax rate, just for simplicity's sake, that's $3,000, $4,000 worth of tax savings. So it's called the Masters rule. Opportunity to think a little bit differently about events or how you might be using home office. So cost segregation studies, this has been around for a while. Cost has gone down on this. So even if you just have residential real estate that you're renting out in Seattle, cost has gone up so much that doing these studies now makes more sense. Basically, it involves having an engineering firm come look at your property. They come back and they say, hey, X percentage of the building is related to HVAC, windows, doors. Those all have much shorter depreciable lives. So rather than depreciating something over 39 years, how about we depreciate a third of the purchase price over 5 years? And oh, by the way, that 5-year property now qualifies for Section 179 depreciation or bonus depreciation. So let's just take that entire expense this year. So that's been around for a while. If you haven't been using that for commercial properties, that's an opportunity that you should be taking advantage of. If you have residential real estate in the greater Seattle area with the costs going up, the savings that you get now is making more sense. So that's been around for a while. The last two are really relatively new in the last couple of years. De minimis safe harbor election. This allows you to add, every business return should have this election because you can't amend and add it later. So if you look at your business returns and you don't have this on, you want to make sure that it gets added. It allows you to directly expense, so not even deal with depreciation on items $5,000 or less. And it's per item on an invoice. So you could have $1 million invoice, but each line item is $5,000 or less. You just go ahead and expense that entire invoice. So if you did a remodel, tenant improvements, sort of thing, before maybe you were capitalizing and depreciating, now we get a detailed invoice. We just go ahead and expense all of that. And then when you sell it, because you didn't depreciate it before, you don't have to deal with what's called depreciation recapture and paying higher than capital gains rates. So it's a way to significantly increase the amount of assets that you're directly depreciating. This would be the same with computers, anything with your building. And then the last thing really quickly, partial dispositions. The idea there is that you can't really have two roofs on a building. So when you tear off that roof to build a new roof, you've actually partially disposed of part of that asset, and maybe that's $1 million building, and that roof is 10% of the value. We now take a $100,000 loss in the year that we do that, and then when we build the new roof, we get itemized receipts, right? And then we directly expense all of the construction of that new roof, and we don't deal with depreciation. So that allows you to now add, maybe several $100,000 in expenses that you would have otherwise been depreciating over, say, 39 years.